Hello everyone, welcome back to Accounts is Easy. Yes, your channel which makes accounts easy for you. Now, we are doing one of the easiest chapters, Goodwill. And before we continue with the next method, super profit method, one small tiny piece of advice for you. Currently, the summer vacations are going on, and this is the time which will decide whether you make it or break it. Your entire year's progress depends very much to a big extent on these vacations. Yes, trust me. This is the time where many of the students just take a laid back attitude and wait for the schools to reopen and then the pressure of exams, tests, etc. But if you work hard this time, the entire year will go absolutely smoothly. Yes, please take this advice from your teacher and start working. Whatever you've missed, whatever you have not covered 100%, this is the time to cover. Now or never. Come on, take charge of the situation or lag jao kaam par. Yes, all the best to you. I hope you subscribe to my channel and stay tuned to whatever updates are coming. So let's start with the next method, which is super profit method. Yes, super profit. Super is something which is not just the normal. Okay? Before this, we have done the simple average method and the weighted average method. Super profit. Again, it is based on profit. The entire goodwill is based on profit. And we have known how to arrive at the correct net profit. Right? Correct profit of the given years. All the adjustments done. And here we are talking about super profit. ये super profit क्या होता है? What is this? Suppose a business has invested around say 5 lakhs of capital. This is basically the investment made in the business. So this 5 lakhs is the amount that the partners have. We're talking about partnership. Partners have invested in the business. And normally, in such a business in which they are, okay, whatever type of business, the risks are, evaluated and a considerable, normal rate of return is expected. Say you are in manufacturing, trading, or a fashion related industry. Anything, every business will have its own level of risks and returns. So, if suppose in this business 15% profits is normally expected, meaning this is the bare minimum we expect. Itna to hona hi chahiye. Of course, there can be more. So, 15% of this will be termed as normal profits. Normal. Any business in this kind of industry, will earn this much. Okay. So 15% of 5 lakhs, how much is that? 75,000. Yes. So in a year, by investing 5 lakhs and expecting a 15% return, I should earn a profit of at least 75,000. This is normal. But what is super? Super is normal se upar, right? More than normal profit. Yes, more than normal profit is called super profit. So, how much is the super profit? I will have to compare the normal profit with the actual average profit. If my actual average profit is more than the normal profit, then obviously I am earning more than the normal business. I am a cut, above that, meaning I have something more to me. That is why I am earning this extra profit. So suppose my actual average profit is 90,000. And you know how to calculate average profit, the correct average profit, right? So this might be given, this you might be calculating in the given sum. So actual average profit is this much. Normally I am expected to earn 75. So how much extra am I earning? 15,000 extra. This is called super profit. Whatever profit I earn more than the normal profit is called super profit. And when I use this super profit to value goodwill. It is goodwill by super profit method. So in this case, if goodwill is to be valued at say 5 years purchase of super profit. So super profit into 5 years, 75,000 will be my goodwill. Yes? Is that clear? So that is how we get super profit value method goodwill. That is easy. I told you goodwill is one of the easiest. So let us have in writing everything here, the formula and things like that. So here, very quickly, I'll read it out to you, whatever we have discussed till now. Super profit method, and please make a note of all of this, so this is all clearly in there in your head, all in one place. Alright, please make a note of it. Now, normal rate of return can be called market rate of interest, or it can be given to you in the sum as normal yield, expected rate of return. All of this will mean the same thing. Okay, so this is to be given in the sum, nothing that you have to know or assume. Capital employed is the amount invested by the partners. For now, this much. I will give you a detailed formula for capital employed. So normal profit will use both of this, normal rate of return and capital employed. So you will multiply the normal rate of return, it's a percentage obviously, so that is 100 by 100, into the capital employed. This gives you normal profit. Now normal profit we will use for calculating super profit. We will subtract normal profit from actual average profit. And so goodwill will be super profit into number of years purchase. Number of years purchase has to be given to you in the sum. Okay, I hope you've noted this and everything is clear. Now we go to a very important thing in this entire, you can say, chapter. This is the very conceptual part of this chapter. Okay, so please pay careful attention. Calculation of capital employed. We are talking about how much money the partners have themselves invested as their capital. Yes. So this can be found out with the given information to you. Sometimes you'll be given the balance sheet on the date of admission or date of valuation of goodwill, or you might be given certain random figures. So you will have to find out. So there are two approaches to finding capital employed in a partnership, from the liability side of the balance sheet or from the asset side of the balance sheet. Both will give you the same result. If you have the whole balance sheet in front of you, you will see you take the liability side approach or asset side approach. Answer same aana hai. So here, from the liability side you see whatever, partners capital account, credit balances, partners current account, credit balances. Now credit balances will appear on the liability side. If your balance sheet is showing the current or capital account balances in the asset side, it means what? Those accounts have debit balance, meaning partners have withdrawn more than what they have put in. So obviously I can't add that to find capital employed, right? So you have to be very careful. Balance sheet head is clearly shown, but if it is only a list of things, you will have to check well whether partner's capital account is credit balance or debit balance. If nothing is mentioned, you will assume it's a credit balance, because usually it's a credit balance. It has to be mentioned specifically, debit balance, negative, in order to be subtracted. Okay. So from here we subtract partners capital and current account balances, debit balances, and then come to addition, reserves. Where do we see reserves? Obviously on the liability side of the balance sheet. Whose money is that? Reserves? Obviously partners profits have been kept aside over the period of time and we have created this reserve. So that money is always flowing back of profit reinvested in the business, right? So that is also part of capital employed of the business. PL, credit balance. If it is undistributed profit, yes, it will show as a PL account on the liability side. Less. Now, all of this till now was on the liability side. If only this much is given, you will simply add all of this and arrive at your capital employed. But certain things you will have to remove if they are given in the sum. Existing goodwill, meaning book value of goodwill as per accounting standard 26, okay, which deals with intangible assets. treatment of intangible assets. Goodwill cannot be appearing in the books unless purchased. So if you have purchased goodwill, fine, raise a goodwill account. But if it is valued goodwill, you cannot raise. And assuming this is goodwill, nothing else is mentioned, goodwill is valued goodwill, write it off, finish it, wipe it off, okay? So goodwill account we will subtract because that is not at all a real asset for me because it's just valued goodwill. Then subtract non-trade investments. Non-trade investments meaning not related to my trade or business, nothing that will add to my productivity as such. So that amount of capital that partners had gotten, I have invested in some other business. So how come it's a part of my capital employed? No, right? That money has been invested outside the business, so obviously it's not a part of capital employed of this business. So please subtract any non-trade investments. Also remember, very importantly, if nothing is mentioned, only investments is given. Investments are considered non-trade investments only, okay? It has to be specifically said, trade investments. Then only you consider that as trade investments. So if the balance sheet shows or the list of items shows investments this much, subtract. Consider that as non-trade, not in the business, out. Okay. Last, fictitious assets. Fictitious meaning assets that are not real. Not real. They do not have any saleable value, nothing. Examples. What are the examples? PL account, debit balance will appear in the asset side. Subtract it. It's not a real asset. PL account, क्या करेंगे? Can we sell this? Can we convert it into cash? No. So they have got no real existence. Also, advertisement suspense or deferred revenue expenditure account. Deferred revenue expenditure. All of this will appear in the asset side of the balance sheet because these are unwritten off losses or expenses. Unwritten off. Had you written them off, your partner's capital balances would have gone down. So if you have not written that off, write it off now. Meaning basically subtract it. For the valuation of goodwill, let us come to the exact amount of capital that is there in the business. Okay? Now come Nazata. So here we need to adjust that with all of this. Very important. Please make a note of this. Now same thing if I come from the asset side. Asset side I will have all the assets. So let's not name all the assets here. We'll take it as total assets. Let's take total of the balance sheet there. All the assets. Excluding, of course, whatever we subtracted from here. Goodwill, non-trade investment and fictitious assets. That is anyways not part of my assets. Total assets. From there, please subtract all the outside liabilities, meaning third party liabilities. Okay. So, because those are what? Those are not part of my capital employed. I borrowed that. Bank loan, creditors, bills payable, outstanding expenses, etc. Those are outside liabilities. So, subtract that. Both ways you will get the same answer, children. You can try that. Alright? Of course, we will also try it here. Let us take a quick sum to find out capital employed. Meanwhile, just read that for this formula once again quickly. I hope you made a note of it. And so that you can follow better the next sum that I am taking here. Let's start. From the following information, calculate goodwill based on 4 years purchase of super profit at NRR 10%. Alright, super profit, I know I have to find out super profit and also I have to, okay, just a minute. So on the basis of 4 years purchase of super profit at NRR 10%, average profit of the last 3 years is given as 80,000. So for my super profit method, if you've just seen the formulas, what all do we need? Normal profit. For normal profit, I need NRR and capital employed. Okay, capital employed I have to find from the given balance sheet. Normal rate of return is given to me and I also need actual average profit which is given to me directly. Average profits are 80,000. Alright. So that is done. So only thing that I have to arrive here is at the capital employed and then things will be easy for me. So let's see. I'm telling you from both sides, both approach. See, follow whatever you've written in your formula. Okay. From the liability side, please see. Liability side says partners capital accounts. So both of this should be added. S and T. Current account. Yes, it is appearing here. So this also will be added. Correct? This is the liability side approach. We have general reserve. General reserve is created out of profits of the firm. So this also is a part of capital employed. Employee provident fund. Employee provident fund. Don't go by the word fund. It is an external liability. This amount the business has to pay to the employees. Okay, this is deducted from their salary and it is deposited to the government. Okay, as EPF. So EPF is an external liability. This will not come under liability side approach. Okay, so this is not to be taken. Loan from T. T is a partner, but loan from T is different from capital of T. It's a borrowed fund. So this also will be not taken in capital employed. Creditors and bills payables are obviously third party liabilities. You know, we need to pay to creditors, and creditors of course who have meaning to whom we have signed the bills. So these two again are current liabilities to the third parties, not going to come here. So all I need to add here is this 5 lakhs plus 3 lakhs, 8 lakhs. This is partners capital plus reserves, current account of 50,000 and then reserve of 40,000. Okay. So in the plus thing we have only this. Of course there can be minus. So tell me how much we have to minus and what all. We have to subtract from here. Furniture? No. Furniture is very much a normal asset. Land? No. Investments. I told you investments, if you see it should ring the bell. What kind of investment is this? Trade or non-trade? Not mentioned. Not mentioned meaning non-trade. So I'll have to subtract this. Goodwill, existing goodwill, subtract this. Then we have debtors and provision, no problem. We'll take 40,000 there. Cash, current account of T. Oops, current account of T meaning money overdrawn by partner T. So I have to subtract. Advertisement suspense, a fictitious asset, and also PL account. See here, PL account, it's coming on the asset side meaning it has a debit balance, it's a loss, unwritten off loss. So all of that I need to subtract. Oh, the subtractions are more than the additions. Okay, so let's see if I subtract all of this. 1, 2, 3, 4, 5. 1, 2, 3, 4, 5. 5 items gone. The answer is coming as 5,75,000, meaning my capital employed. This is the liability side, okay? Is coming to 5,75,000. Fine. Let us check, is it coming the same from the asset side? Capital employed from the asset side. Asset side, what did we do? We have to take the total assets. Total assets meaning the total of the asset side, which is 995,000. I have taken all the assets. Now I'll exclude what I don't want. See, these things anyways I don't from, be it from the liability side or asset side, investment, goodwill, etc. I'll subtract, right? So investments, then goodwill, then current account of T, then advertisement suspense and profit and loss account. All of this I have excluded. Also, I have to subtract outside liabilities. Outside liabilities meaning 1, 2, 3, 4. Yes, all these 4 are outside liabilities. So this 10,000 employee provident fund, then loan from T 20,000, creditors 60,000 and bills payable 15,000. If you do this, of course the answer has to be the same, 5,75,000. Both ways it will come the same, has to. Okay, so here we have got our capital employed. Now let us go to calculation of goodwill. So for goodwill we need normal profit. Normal profit is equal to capital employed into normal rate of return by 100. So 5,75,000, 101. 57,500 is my normal profit. My average profit is given as 80,000. So can I calculate super profit? Yes. So what is the formula? Average profit minus normal profit. So that is coming to as 80,000 minus 57,500, 22,500. So 22,500 is your super profit. And how should you find goodwill then? Goodwill is to be valued at, 4 years purchase of super profit. So super profit into 4, right? So into 4 will give you 90,000. So your value of goodwill is 90,000. Okay? That's how you calculate this. A few little very important things here, children. While calculating your goodwill, see, I am not writing all the smaller formulas here because I've just given you the entire list. But whenever you are doing this, whatever you've done here, please give the proper formula for this, okay? Whatever you've added, please write. Normal profit, you should write the formula capital employed into NRR by 100. And then super profit is average profit minus normal profit, that formula. Goodwill, super profit into number of years purchase. All these small little formulas will carry marks. Yes, there are step markings, a lot of step markings in account. So please do not miss out on writing the formulas. Please do not use any short form. Otherwise, no marks for the formula, even if it is right. Okay. So why do you want to lose marks there? So try to get 100% of this sum because this chapter is very easy. Okay. So we just left with the last part of this. One more video. Capitalization of average profit and super profit. Bas, finish. So till now, I hope everything is clear and I hope you will note it down and solve related questions from the book. Alright? All the best and keep doing accounts the simplest of way. Thank you for watching. Do share, subscribe and like. Bye-bye.